Good afternoon, ladies and gentlemen. Welcome to the Good Energy Group PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, all questions submitted today will be reviewed, with responses published on the Investor Meet Company platform where it is appropriate to do so. Before we begin, I would like to submit the following poll, and as usual, if you could give that your kind attention, I'm sure the company would be most grateful. And I'd like to hand you over to CEO Nigel Pocklington. Good afternoon, sir.
Good afternoon. Thank you, Jake. Good afternoon to everybody on the call. I'm Nigel Pocklington and I'm Good Energy's Chief Executive. I'm joined today by Rupert Sanderson, who is our Chief Financial Officer. And to give you a sense for what we're going to try and cover in what should take around half an hour to talk you through, after a short overview from me, I'll hand over to Rupert, who will give us the details behind the first half of the year's financial performance. Then I will update investors as to our progress along the strategy that we set out in our interim presentations earlier this year. And by way of an overview, there is obviously, sadly, only one place to start, and that is with the unprecedented nature of the energy market. The UK and indeed Europe is now going through an energy crisis and an energy shock, at least as significant of those in the oil market of the 1970s, if not more so. I have put up what is, I suspect, quite a familiar chart to many, which is the winter ahead price of gas and electricity from last summer through to this point. You will see the graph of extraordinary levels of price rise and a considerable amount of volatility, particularly with those three shock spikes in the marketplace, the last of which we have seen towards the end of August this year. And I start with this really to offer three clear thoughts on it. The first is that it is first and foremost a gas crisis. And there is much commentary around everything from net zero through to whether we should still be digging for coal. Ignore it. It is absolutely a gas crisis. 95% of the increases in consumers' bills are being driven by the wholesale cost of gas, which even before Russia's invasion of Ukraine was a commodity in shorter supply. And obviously this has been hugely exacerbated by international tensions. We are quite clearly seeing the cost of European war in our energy bills. And we have been unapologetically vociferous, despite the fact that we are one of the more specialist and smaller suppliers in the marketplace, by pointing out the economic and social impacts of this, or potential impacts of this, and pushing the government for further and further action. And as such, I very much welcome the government's latest intervention to shield consumers from some of the impact of these price rises. And we look forward to hearing what the government has to say in terms of further support for businesses this week. I think the second thought to focus on is that whilst we very much see Good Energy as a brand and a business which is investing for the future energy consumer, and much of our long-term investment is around investing to help people make the energy transition, be it in their consumption at the home or in business or in their transport. A crisis like this does demand that we spend a proportion of this presentation and indeed of our time talking about our risk management and operating stability. And that in turn has a pull on some of our working capital needs. So to avoid too much jargon, that literally implies is just the short-term difference between cash we've got going out and the speed with which it comes in. So we will definitely address both our short-term risk management and dealing with the shocks of the supply market, as well as our longer-term ambitions during the course of this presentation. And I think the last and key thought really is that at both a national and a personal level, this crisis is beginning to drive an increasing awareness of the importance of energy independence, the important role that renewables can play in this, and the fact that actually a good proportion of our managing this crisis could well be done at the household level. And there is increasing levels of interest in the energy transition, in energy technology, in greening consumption, so that more and more people can take more control of their own energy generation. And as such, whilst much of the products and services that this implies are new to Good Energy, these are absolutely the roots of Good Energy's foundation by my predecessor 20 years ago. We've always been at the forefront of driving greater self-generation and giving people more of a chance to take control of their energy position. And that strategy we began to talk about in more detail at the preliminary results presentation in March, but just to remind everybody on a page, we called out really a new purpose for Good Energy, which is there in the yellow, supporting 1 million homes and businesses cutting carbon from their energy and transport use by 2025. Actually, the reach between ZapMap and our supply business, which has also gained a small number of customers in the interim period, means that we're already well on the way to that target in some ways. We're over 730,000 homes and businesses touched by our products and services at the moment. But whilst if that why sort of is really very close to the roots of the company's foundation, the way in which we do it has changed. We no longer are a generator, we're no longer an asset owner. There are people with better access to capital who can do that at a greater scale. What we are is a supply business, a very sort of distinct supply business at that, with a considerable ambition to grow and invest behind further energy services, be it in home energy consumption or in travel. And much of what we do in terms of the latter part of this presentation will focus on how we're investing to make that happen. But I will now hand over to Rupert, who is going to give you a sense for how this plays through in the numbers for the first half of this year.
Lovely. Thank you, Nigel. Good afternoon, everybody. So I'll start with the P&L. And this is really a story of two quite different first halves of the year. And it's really the sort of economic and commodity environment that was in place during those two periods. So we've seen a pretty stable sort of customer number position across each one of our business segments over the course of these two periods. But we've seen a very significant rise in revenue, which has been driven by the price rises we've put through across all of those segments in response to the rapidly rising commodity environment. But in terms of those sort of two different sort of economic backgrounds, backdrops, in half 121, we were still in the midst of that second COVID lockdown, and we had been buying power and gas all through the second half of 2020, and that was considerably advantaged in terms of the reduction in demand and reduction in costs that COVID drove. So that's probably the sort of extraordinary benefit we took in the first half of 21, and therefore we've seen our cost of sales, our commodity costs, rising by more than the revenue change that we've put through over the course of the year. We're expecting to see that rebalancing over the second half of the year. And so I think that the extremity that we see in those two periods is somewhat behind us. But it does highlight the impact of the timing and the phasing of commodity cost increases and then the revenue changes we make to balance them. In context, the business as a whole, if you exclude ZapMap, is approximately break even for the first half of 22, compared to a profit of nearly £5 million in the first half of 21. But the number we don't see on this page is the impact of rising commodity through the second half of 21, which we had anticipated, which led to an £8 million loss in that second half of 2021. So we see the first half as very much a stabilisation and a sort of slight return to normality in terms of the balance between the revenue and the cost of sales. Flick on. Thanks, Nigel. So just to give a quick visual description of this movement, we start with our profit in half one of the comparative period at 4.8 million. We have got a small volume benefit, and that's predominantly in our business electricity segment, where we have got a smaller number of customers, but a higher volume compared to the comparative period. This is slightly offset by a reduction in gas demand, which is really driven by higher temperatures in 22 compared to 2021. The second impact is the large delta that I described in terms of the relative change in commodity cost and revenue, so I won't go into that further. ZapMap is still within the profit before tax figures of the business at the half year. It will be deconsolidated at the in the second half of the year. Now we hold less than 50%, but that business continues to invest and grow, and reported a slightly larger loss than it did in the comparative period. ECL is our old word for bad debt provisioning, and this is really a methodology change as we went through the full year 2021. This doesn't arise out of a worsening set of collection rates or a deterioration in our metrics. This is really just normalizing the way in which we look at the segments of our business and the level of detail we go into when we do that provisioning methodology, and that's entirely consistent with how we reported at the end of 2021. The reduction in finance costs, we'll continue to see this in the full year. This is a result of the generation asset sale. A couple of small other movements leading us to that reported 0.7 million pound loss. Within that, a ZapMap loss of about £800,000. So the business as a whole approximately break even, excluding our 100% share of ZapMap. Turning to cash, I'll pull out three main items here. The first is the P&L impact that we saw in half 1 21 compared to the comparative period. Really flows through to the line item, which is cash generated from operations. So you can see the year-on-year movement there, and that is broadly reflective of the change in profitability over those two respective periods. And I will highlight the cash flow for investing activities as a little under £19 million, which is represented by the sale of the generation assets, less the fees associated with that, and the £1 million investment we had made into ZapMap in the first half of the year, so a little under £19 million. That leaves us with cash and cash equivalents at the end of June of £21.7 million. And just to give people an up-to-date position on where our cash balance is at the end of August, our last reported period, it's a little higher at about £22.2 million, and that includes the additional £2.7 million investment we made into ZapMap in early August. And for those of you who are close to some of the market mechanisms within the electricity market, it also includes the settlement of all of our renewable obligation certificate obligations for the 21-22 compliance period. That's a significant obligation that all suppliers in the electricity supply market have to fulfill around this time of year. Thank you. The main driver in terms of continued strength in terms of our cash balance has been the performance we've had in collections, and this has broadly followed our change in revenue and change in pricing, which we've made across all of our business segments. There's a little bit of year-on-year improvement that we are seeing in Q2 and Q3 of 2022 compared to the respective period in 2021, where we called out a bit of a shortfall associated with the implementation of our new business billing system in that period of summer 2021. So we've seen the recovery from that, and we're seeing cash collection continue to perform in line with our expectations. I think as we went into, just in terms of the balance of year, clearly with prices continuing to rise, it was one of the things that we were probably increasingly concerned about in terms of ability of some customers to pay over the course of the winter. We now have clarity on the domestic support package from government, and we await information in respect of business support packages, but that should substantially underpin the continued collections that we would expect to see increasing over the course of this coming winter. And on the other side, so in terms of customer collections, we've talked about the sort of cash that's coming in. In terms of cash that's going out and how we are managing that, we continue to actively plan for winter 22, and much of that is based on our experience of navigating winter 21. We continue to hedge appropriate on a forward basis, and we're now over 90% hedged for the full winter, assuming seasonally normal weather conditions. And building upon some of the challenges that we had last winter, we have reduced our exposure to wind for this coming winter. That presented some particular challenges in Q4 of 2021. And on the risk of under-delivery of some of our PPAs more widely, we've now built that risk further into our tariffs and our tariff changes that we are making over the course of the winter. Thanks, Nigel. So just in summary, as we are now through 8, nearly 9 months of the year, we continue to trade in line with the expectations for the full year of business performance. I would highlight again, the business has got a strong cash balance. We continue to perform strongly in terms of cash management and cash collections. And as many of you will know, we are substantially debt-free on a gross basis, and we now hold over £16 million of net cash. We have demonstrated our commitment to further investment. So we have invested into the recent fundraising into ZapMap, and we would expect to continue to look for investments in both the decentralized energy and mobility sectors going forward. And as Nigel highlighted, the business is currently using a very significant amount of working capital, and that is felt most strongly when commodity prices are rising, and that's the environment we've been in for over 12 months now. When prices start to stabilize, that working capital draw balances out, and then when prices and if prices start to fall, then we would start to see the benefit of some of that working capital that we have invested within the business coming back and potentially being added to the amounts that we can look to invest in our future strategy and growth plans. I think I'm handing back to you, Nigel. Thank you.
Thank you, Rupert. So hopefully that gives a sense really for the fact, as Rupert says, that almost having seen the extraordinary shock of last winter, that the business is onto a stabilised footing, and a lot of the impacts are sort of beginning to flow through the P&L accounts, and therefore we should be able to hit our full year numbers. I wanted to give everyone a sense for how we are doing in terms of delivering on the strategy we set out at the preliminary results presentation in March. And to remind you, really, that sees the business in terms of 3 areas: a differentiated supply offering, given its backing with 100% renewable electricity, very much focused at consumers who almost understand and want to buy into the difference. A generation business, which is really rooted in our long-standing support for and services for people who want to generate their own power, and actually beginning to try and innovate and invest into other areas, as well as improve our services for home generators. And then lastly, a particular interest in clean transport. So we are making it easier to own, drive, power and pay electric vehicle as core to our mission as a company. Obviously, most of that initially coming through ZapMap. So taking each in turn, let's start with the supply business. Obviously, there's considerable focus in terms of the news flow at the moment. When I talk about our supply business, what I would say is that it is a differentiated offering. So it is 100% renewable electricity aimed at consumers who want to particularly buy into that green product. Our goal here is really to grow this business in a sustainable manner. And by sustainable, I mean that what we cannot afford to do is find ourselves in the near-term wholesale market needing to buy significant amounts of power and gas without the ability to bring the revenue that matches that in relatively near time. That is how energy companies have got into trouble, and that is not something that we are going to do. Our goals in the nearer term really were around retaining our domestic business after some periods of churn, to make sure that we felt that the health of our business portfolio was right, which means that we are focusing that offering on businesses who have a strong payment track record and who particularly want to buy into the renewable product offering. And to enable that, we've launched a new product, which I'll describe in more detail in a minute, around making sure we can net and match the consumption of the larger business customers against our ability to source that electricity from PPAs. And as a business with a differentiated offer, we do think that offering strong service is an important part of that. So maintaining our Trustpilot rating is a key goal for us. And how we're going is that Ofgem continue to be supportive of our specialist position. So as you might imagine, there is a lot of engagement with the regulator at the moment, and both they and the business department continue to show that they understand the differences between a general supply proposition and a deep green supply proposition. So for example, the recently announced energy price guarantee is really a top-up payment that applies just as much to our tariffs as it does to the broad brown power tariffs on the marketplace. They are underpinned by platforms which we've talked about before, but I'm happy to report to investors are both now operating as designed. You can see that really in the service ratings that Kraken helps us deliver. Because Kraken, remember, enables smaller and more capable teams to see the whole of a customer's position and therefore deliver solutions more quickly. Frankly, it also means that we are able to respond to significant changes in the government support packages for consumers, which you're seeing at the moment. So they were announced on the 8th of September, and we'll be in a position to deploy them on the 1st of October. Smart meters are an important enabler of the energy future, and we are on track now to see 50% of our customers on smart meters by the end of this year. And then lastly, whilst many of the small suppliers who have ceased to operate wouldn't have had an energy trading operation, we've always maintained one, and we see the flexibility that gives us as being important in terms of our trading of our energy position, but also in terms of enabling the matching of PPAs to bigger business supplies. And that's worth focusing on briefly. So one of the potential pitfalls of the current energy market would have been a difficulty to maintain or even grow our provision to the larger users of energy, which tend to be business users. One way to resolve that is to get sharper in terms of our ability to match PPAs, the long-term power purchasing agreements we sign with small generators with business customers. That's something we've done roughly in the past, and we've sharpened up now. We have a matching product in the market, which has enabled us to sign up to 48 large customers so far, and we will continue to innovate in this way. So if that's the supply business, which I think is in robust health, but requires a significant investment of working capital at the moment, I want to turn to the two areas where we are investing longer term capital for what we think will be longer term growth and returns. And the first of those is in decentralized energy. So helping households become their own power station, which increasingly means not just generating power through solar, but also storing and potentially sharing that power. It's an area we would like to see ourselves gain market share in over the next few years, and one that we think is capable of faster growth than the supply business. Well, how are we doing this year? We focus quite a lot of our internal resource on launching new and innovative products for self-generators, which we'll be launching in the fourth quarter of this year. And this is really using smart meter data to enable us to pay for the amount of power somebody actually generates rather than a deemed or defaulted amount or deemed amount of power, which is a rough estimate that often underestimates power generation. So this is an improvement for generators because they should be able to see higher returns for their domestic solar. It's also an important enabler for any future energy services because effectively what you're doing is closing the loop between on-premises generation, solar panels on your roof, and the meter and the feedback loops within the industry, which will make further innovations easier to deploy as things like storage become more widely available. And so from that point of view, it is an investment we're happy to make. It puts us into an industry leading position. And by the time we talk again in terms of results, we will have a sense for how that investment is going for us. It is certainly one that will capitalize on what is an area of growing consumer demand. Naturally enough, as energy prices have risen, consumer interest in energy independence and solar panels, for example, have leapt up. And you can see that some of the data there in stores are running at about 3 times the volume as they were a year ago. And we can see that searches for solar panels on Google in the UK reached an all-time high last month. And then the last area of the business to talk about progress on is our support for the electric mobility market, where our ambition is basically to make EV ownership a more straightforward proposition. So again, to remind you of our goals and our strategy in this area, we do think that this is an area of potentially rapid growth for investors, really fueled by the very high growth driven by the take-up of electric vehicles, which are generally forecast to see compound growth rates above 40% for the next 5 years as we move towards the phasing out of new internal combustion engine sales by 2030. Our nearer term goal was to ensure that ZapMap was funded for accelerating its growth and to maintain its penetration of the market and to show that its products and services were growing, and also to begin to experiment with our own EV charging offering and partnerships. And how are we doing? Well, I think the first headline there, which is something that we announced last month, is first and foremost that ZapMap has successfully raised £9 million, with us contributing some of that, as a Series A investment round. And we've brought in FleetCor, a leading operator of payment services for the petrol and fuel sector for now, as a co-investor. This I think is good news for a number of reasons. Firstly, it is the first time we have independently been able to put a value on ZapMap and our stake in the business. And you can see there that implies a post-money valuation after the money's come in of just over £26 million for the ZapMap business, which we own just under half of. I think, secondly, FleetCor looked to be a fantastic partner. They're a very big company. They obviously have a huge interest in the energy transition, since their business is entirely predicated on payment services for petrol and diesel cars at the moment. And they are likely to be therefore a very powerful ally for ZapMap. We're already working with them to power a fleet market focused payment product in the UK. And since the deal closed, FleetCor have showed the shape of their intention for this market by acquiring Plugsurfing, which is a European EV payment platform operating on about 300,000 charge points across the continent, which again shows, I think, that they could be a very valuable partner for us. What are we going to do with the investment money? Well, 2 areas spring to mind. First and foremost, we're going to make a further investment in terms of improving the user experience on the platform and accelerating particularly the payment services offering. And secondly, by the end of the year, we'll be beginning to set the scene for its international expansion and beginning to explore 1 or 2 markets where we can take ZapMap out of the UK. Just to be a bit more transparent on some of ZapMap's numbers, usually I would start by describing the ZapMap business by pointing to the fact that whilst it spends very little money on marketing, it maintains an incredibly high penetration of electric vehicle users. You can see that in the black line on the bar chart there, and that, if anything, has slightly ticked up during the course of this year. So ZapMap retains its market penetration and grows as the electric vehicle park grows, it means that it has grown its registered user base by over 100% during the course of the last year. Perhaps more importantly, it is continuing to make progress in terms of its key product offerings. So we now have 10 charge point operated networks. As you can see, they're representing about 25% of the rapid network signed up to Zap Pay, and with the All-Star electric fuel card, a position in the fleet market with the leading provider of fleet payment solutions. Its subscription business is continuing to grow, and we have seen take up from one major car manufacturer in terms of offering a 2-year Zap Map subscription with all new car sales, which will be furthering Zap's eventual goal of embedding itself within the overall ecosystem of owning and driving an electric vehicle. So happily, Zap Map is trading well and is trading along the lines of the plan it raised the £9 million from earlier in this year. And so in summary, what I really wanted to say was to remind everybody around how this fits with the capital allocation strategy we laid out again in our preliminary results presentation, which is really, as you've heard me say, our long-term, we are investing for the long term in what we think are growing markets, and markets that are important for delivering on our mission in energy services and electric vehicle supply. In the shorter term, there is obviously a working capital need driven by the energy crisis for our supply business. And to remind you how that looks in terms of capital allocation, what that therefore means is that we have a significant amount of cash on the balance sheet at the moment. Firstly, some of that will be going towards being a buffer in a market characterized by significant shocks in the wholesale market. So if there are moments when any short-term energy needs to be brought in at that very high price before it can be recouped from tariffs, we will have the ability to do that. Nonetheless, we do think that further acquisitions, as we've seen with ZapMap, could be an important part of our corporate development, and I would anticipate that funds will be going towards acquisitions as and when they become available. It does mean that we have, as we said in March, dropped any sense of a progressive dividend policy. The company no longer owns generation assets, for example, and therefore we no longer see ourselves as having those characteristics of a utility. But we do see that some element of a dividend payment is important for some of our shareholder groups, and therefore at the interim stage, we will be repeating last year's policy of paying an interim dividend of 75 pence per share. And in terms of formal presentation, that completes our update. So, Jake, I'm going to hand back to you to compare the Q&A.
Perfect. Nigel, Rupert, thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Nigel, Rupert, we did receive a number of pre-submitted questions ahead of today's event, as well as you can see in the Q&A tab, a number of questions have also been submitted throughout today's presentation. So firstly, thank you to all of those on the call for taking the time to submit their questions. And Nigel, Rupert, if I could just hand back to you to run through the Q&A tab and respond to those where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Thank you, Jake. So let's start with the first one there, which is one that we're asked very frequently, which is from somebody who doesn't use gas, but rightly picks up on both my remarks and our published remarks around the gas price driving the cost of all energy. Why have our electricity prices risen when the input costs on renewables haven't? I think the key thing to say here is that this is all rooted in the current structure of the energy, and particularly the electricity market, I should say, in the UK, which is that whilst clearly the input costs of renewables, the wind, the sun, water, don't rise in cost, the market is based on a settlement every half hour on the wholesale market, and the price per half hour is set by the last generator to come on stream, which will be a gas generator. So at the moment, a structure for the market which made a lot of sense 20 years ago or so, when all power generation sources were relatively high cost fossil fuel sources, and actually led to a very stable adoption of a privatized energy market in the UK, is no longer fit for purpose because it routes renewables, even the kind of renewables that we contract with. So over time, our PPA prices, the price of those contracts we're signing up with smaller generators rise because of it. Until that is decoupled, we will not be able to decouple the price of electricity from the price of gas. I'm happy to say that, and I'm not privy to much more in terms of information than anyone who's reading the FT or the Times, but it would appear to be the case that as part of the government's view on new energy strategy, the need to reform the wholesale market is understood, and we can anticipate this changing in the medium term, is the best I can say. But for now, we are as much part of the wholesale energy market and its rules as a fossil fuel supplier is in that sense, and therefore the two prices are linked. Rupert, anything you add to that?
No, that's very clear.
Which is it. Thank you. So the next question relates to the takeover bid. The next two questions relates to the lapsed takeover offer from this time last year. The board rejected £4 a share for arguments that were very clearly set out in our documents at the time. As a reminder, these are all regulatorily controlled documents with a high degree of verification in them. And that argument essentially was that £4 a share undervalued the business because of the value of all the elements I've just talked you through and the future potential within the business. Obviously, since then, I suspect in the short term, the sentiment towards the energy market and its volatility is very much reflected in the way our stock trades. But nonetheless, the board remains committed to the strategy I've been talking about, which is a significant investment behind energy services and electric mobility. And you can begin to see some proof points of that coming through, not the least in the fact that the target prices of the investment houses covering good energy in aggregate is well above £4 a share. And that is because you can see through to verifiable numbers on things like the value of our stake in ZapMap, the amount of cash we've got on the balance sheet, the size and scale and the robustness of our generation business. So we remain of the view that that was the right course of action to take. And as we deliver on the strategy, you would expect the share price over time to follow. Scrolling down, if anyone wonders what the pauses are from. So there's a question on hedging, which I'm going to ask Rupert to tackle. Given the ongoing energy crisis, has the company managed to put in place forward hedging to protect its position in the market? You touched on this in your presentation.
Yeah, no, so I think I'll just go back to a couple of the comments that I made earlier. So we hedge on a forward basis across both power and gas. For forward seasons, we've highlighted our position for this coming winter. So it's obviously a very critical one. And we've highlighted that across our overall power and gas needs, we are over 90% hedged for this coming winter, assuming that it is a seasonally normal year in terms of temperature and things like wind and solar. Now, obviously, it's never going to be a perfectly normal winter. And last year, one of the exposures we had was around particularly low wind yields and generation volumes in Q4. We are aware that that situation could happen again. Similarly, it could be a very windy Q4. But we have taken mitigating actions this year, particularly on wind, in respect of lowering our proportion of wind within the mix of our generation over the course of this winter. And we have also been reviewing the cost of some of these items that we saw in winter 21, and we are factoring that into the tariffs that we have been setting for this coming winter as well, and the prices that we give to our PPA generators. So I think that we are in a good position, and I think that we have taken learnings from last year. There will undoubtedly be surprises that are thrown at us over the course of this forthcoming winter, but I think that we have taken appropriate and sensible steps to manage the risk.
Thank you. The next one is then on ZapMap Fleet Core and the opportunity to expand in Europe. So the short answer is absolutely, there is an international expansion opportunity for ZapMap. That potential was part of the documents we had in the fundraising round, so investing behind getting that started is part of what the money we've raised for the next couple of years of ZapMap's development will do. We are focused on trying to find markets where the ZapMap offer particularly makes sense. So that's markets where public charging is an important part of the electric vehicle ownership process, for example. And we have someone in market, so there's a member of the ZapMap team now based in Europe, and we are hoping to lay some of the groundwork for that this year. So absolutely an opportunity, which obviously differentiates itself from the power supply business, which I think in its nature will always be very domestically focused. And that is something that ZapMap's management team intend to get on with. So Rupert, one for you, which is, given the cost of living crisis, how is our debt book performing? So
yeah,
you touched again on the expected credit loss, didn't you?
Yeah, so touched on the sort of overall performance in terms of cash collections, and as I highlighted in Q2 and we are seeing in Q3, we've actually got stronger than expected year-on-year cash collections, which I think is mostly due to the impact we saw in 2021 associated with our NSEC commercial billing system migration. So in terms of 2022, we've generally seen our collections remaining very strong, and they have been following our revenue increases. And we have put through a couple of revenue increases already in 2022, and we've seen no material adverse impact in terms of our overall collection rates. Total debt is higher than it was at the same period last year, but I think that is only to be expected given the level of price changes. We will continue to monitor this very closely over Q4, but I think that the government support packages will insulate us, at least to an extent, from the wider impact that we would undoubtedly have seen, I think, without any government support in the face of such steep increases for households and consumers, alongside steep increases they're already seeing in other costs.
Thank you, Rupert. We now have quite a long question, which I'm just scrolling through to get a sense for it. It's really asking about our level of commitment to the domestic energy supply business and the nature of our derogated tariff, and then relating particularly to EV customers. And so I will take that on in a couple of parts, I think. I mean, during the presentation, we've tried to be very clear that we are absolutely committed to the supply business, but we see it one that we can grow sustainably. And by that, I mean that we need to constantly think that even a renewable supplier, and even one backing quite a lot of its electricity through deals with smaller generators, needs to be able to cover the costs of the energy its customers are using in the short term. Otherwise, as we've seen with about 60%, let's not forget that the energy sector in last winter, significant trouble can follow. So when we want to say we want to go sustainably, it is we will only expand our number of customers when we can absolutely be confident that we can fund that in the wholesale market, or we can hedge out that energy consumption. And that, frankly, is why Good Energy has always stayed out from some of the very intense price competition that you saw in the energy sector in the last few years, which turned out to be a very smart decision, because a lot of that price competition was unsustainable. So, we don't therefore see this part of the business as being one that's capable of growing as quickly and without such deep working capital needs as energy services or electric vehicle services can be. But nonetheless, it's an important underpin to what we do. And as the energy market changes, a supply business will be an important enabler of that. We are operating a genuinely differentiated model, in that we're one of only 3 suppliers with a derogation from Ofgem, which means that we don't have to charge the domestic standard variable tariff, and that is because that reflects the genuine higher costs and slightly higher volatility of sourcing power from 100% renewables. There's a lot more work to be done to ensure that you can cope with periods when it's not so windy and not so sunny, for example, and that brings an extra cost into our tariff. We don't actually have some of the data to hand that question asked for. So it came in earlier today, but generally speaking, we will be operating therefore at a premium to the cap because of those additional costs, because they're not baked into the Ofgem calculation of that price cap, and I expect that to remain the case in the future. It's important to stress, however, that all Good Energy customers will be receiving exactly the same level of support in terms of a discount per unit rate as any other energy company and customer in the UK. So the cost of those tariffs, which would have carried on rising, will therefore be controlled by the latest level of government intervention. And in terms of electric vehicles, we would love to bundle more and more services for EV owners and more services for EV owners and ZapMap users. The only thing that's prevented us significantly investing in marketing electric vehicle tariffs, which really tend to discount energy during the night time when people want to charge their cars, is really the level of volatility and uncertainty in the wholesale markets. You would not want to get caught needing to buy quite a lot of energy in the short term on one of those spikes that my first graph talked about. So we've been, like frankly every other supplier in the market for now, pretty coy about reducing them on anything other than a trial basis. But we do have an electric vehicle tariff in the marketplace. We're one of the few suppliers to actually have that offer. And as the market stabilizes, it is a natural place for us to want to focus. In the longer run, and this will depend slightly on where wholesale market reform gets to as well, you would hope that the energy services we can offer begin to make the case not just that these are environmentally better products, but frankly, they're economically better products as well. To get there, we need help from market reform to break the link between the gas price and the electricity price. So, the share price is a forward assessment of the company's prospects. So why is the price currently flatlining and below its May level? I would slightly challenge that in the short term. You know, share prices are sort of long-term way ups and short-term votes, whatever the relative quote is. It's a pretty volatile equity market generally at the moment, and therefore, we are a relatively small cap stock, so the price will move up and down in the short term for a lot of factors. I do think the board remains confident of the arguments we made during the takeover bid that the value in the company is that bit higher, and therefore we over time we'll realise it. But I think it's a difficult environment in the short term for small cap stocks in general and energy stocks in particular. But I don't see the day-to-day movement of the share price as particularly indicative of our prospects. And as you can hear from the presentation today, one of the things we've done is to reiterate our forward guidance, which is really around the recovery from last winter's shocks and the fact that we are managing what we think will turn out to be a profitable energy business despite everything. And then second question, smart meters and internet connectable products to give for areas where mobile signals are very important. So my consumer inbox contains a number of complaints along this lines, which I do when I meet SMS take up. For now, unfortunately, we're all victims of the way in which smart metering was set up in the UK, which now looks to be quite a legacy arrangement involving earlier available spectrums, 2G and 3G. So there is a problem with the smart meter rollout and low connectivity. I will continue to press that with SMS, who are our smart meter installation partner. And when the marketplace offers a solution that the regulator will approve, then we can go into that. But at the moment, I'm afraid we're all dealing with the realities of the way the smart meter rollout was set up, which does depend on some degree of mobile connectivity to make the loop back to the data center. Next one, is align with investing in one of the EV subscription operators. Yes, so frankly, there is quite a lot of innovation in the market for EVs, whereby it's quite easy to pay a monthly cost and own and drive one. They are a natural marketing partner for somebody like ZapMap, and indeed for a charging offer when the market stabilizes. We're obviously in good contact with them through ZapMap, and it's something we would anticipate wanting to do as and when it becomes available. So it's a very sensible call. And I think, frankly, as Zap grows, you'll see more interest from players like this as well as manufacturers in terms of bundling ZapMap subscriptions with their offer. So next one, you still haven't been focused on the smart export guarantee that you said would be in place by September. We'd like us to make a concerted effort to do this. We've been producing so much power that we export it when we need your back-in encouragement. So hopefully, Barbara, in the presentation, you heard me very clearly say that it is the main source of focus, the main focus for our internal development team is on getting smart export launched for us, and so that we can better reflect the actual value of the energy you generate. It is a significant project for us. It is a complex project because there are quite a lot of stages in the energy supply process involved, for example, on the metering side, and then whoever operates your meter, which may not be us, to do that. So it has taken more time than I would have liked to get the project through, but our focus as a company, as a team, remains on getting this launched in Q4, and we'll be rolling that out as soon as we can. So it is coming. It's slightly later than I would have hoped, but nonetheless, it's a key enabler for future products and services for home generators, which is why it has captured a lion's share of our internal investment. I consider myself encouraged. Peter, can the board share thoughts on whether they regret selling the generations at a time when the value of generation is much higher than this time last year due to the wholesale price increases? Has there been analysis of when the finance cost saving of a million from the asset disposal outweighs the higher cost of hedging directly as a result of not having our own generation assets? Rupert, I'd like to bring you into the conversation here. Do you want to take that?
No, I will take that one. So, so the board made a strategic decision in 2021 in terms of the sale of the generation assets. As I think we showed in a presentation earlier this year, we talked about the declining proportion of our own generation to supply electricity to our domestic and business customers. The power from those assets went into our supply customers, and at times has been higher than the current market price, at times lower than the current market price over the period of ownership. So I don't think that we have a regret or a look back in terms of the sale of those assets, and there's considerable uncertainty in terms of the future projections for power prices over the next 10 or 20 years. So today is a moment in time when generation when commodity prices are very high. That isn't necessarily the case for a period 10 to 20 years out into the future. Over a full year period, we will save nearer to £4 million in annual interest costs. And so that is a considerable saving that we would expect to see over the course of subsequent years. So the 1 million that we have seen year on year in this first half isn't entirely representative of what we will see in the future. Is there anything I've missed at the bottom?
Scroll that down slowly.
No, I think.
Well, I think the only things we might add on to that, if Peter, you're particularly interested in this, don't forget we had PPAs in place, we had agreements in place with the assets anyway, so it wasn't as if we would have suddenly sat here making an extraordinary profit from the last 6 months. The price was already locked in, and I would sort of remind shareholders, we obviously substantial argument around this around the time of the extraordinary general meeting we had to have last February. No sooner had we sold these assets than 3 weeks later Russia's invasion of Ukraine happened, and the wholesale markets spiked up massively again. And it was a much better position to be in, frankly, having crystallized the gain on those assets and had the cash in to both buffer ourselves and invest for the future than we would have otherwise have been in the case. So actually, I think subsequent events have really rather vindicated the asset sale more than anything else. There was a question back there from David. It has been a very volatile time since May 21, and thank you for congratulating the team, which actually would be remiss in not echoing these results, and our operating stability don't happen by accident. I'm very grateful for the continued support of both our customers and the team at Good Energy in delivering them. So thank you for the reminder on that. Our key learning over this period, I think, is worth, and I'll bring Rupert into that. I mean, what you will hear us talking about really here is we're trying to position a business for the future with quite sort of forward-thinking products and services at the same time as we manage an extraordinary period of risk and volatility in our existing supply business. And I think what we are trying to get right here, and I'm sure we don't always, but there's a sense that we are making progress, is that we are balancing the need to continue to invest in our future and do so selectively, whilst making sure that we have a very robust position to back up our wholesale business, remembering the fact that 60% of our domestic supply competitors have gone bankrupt during that time, and let's not forget leaving the bill with the rest of the energy sector, and eventually with energy bill payers. So it's that balancing act that we have grown quite used to, and I think our capabilities as risk managers and energy traders are as important in this as they are our ability to kind of try and drive towards the future for energy generators and other customers of renewable power. So I don't know if you know anything to that. It has been an extraordinary period.
It has. I've been in the energy industry for longer, and it has been a extremely unusual couple of years. I don't think I'd add an awful lot to Nigel's time, apart from to say that I hope that he doesn't have a third one that's quite as unusual as the first two.
Thank you. Actually, there's a flow from the unusual energy market to Keith's question there around our solar PPA offer. Do you want to sort of take that?
Sorry, I can't read it.
Oops, so I have to move around this.
So within our overall power and gas portfolio, all of our power at the end of the day comes from independent PPAs. So the cost increase that you will see over a period of time, and not all PPAs renew at the same time. Some might be 6 months, some might be 12 months, some might be 24 months. But over the cycle of 18 to 24 months, all of those PPAs will renew. So if we had set all of our solar PPAs at £80 2 years ago, and they were renewing all of them today, then we would have a 4 times increase in the input cost that we would pass on to our customers. And you can see that if you look at the wholesale markets, which have been driven predominantly by gas, that is the sort of consistent level of increase that we have seen over that period of time. So it is not just us who are buying solar PPAs or wind PPAs who are seeing that price increase. Any participant in the electricity supply market will be paying more for their power, whether they're buying it through a market or whether they're buying it directly with a producer through a PPA. That is the reason why we have seen the whole of the domestic energy industry through the course of the last 12 to 18 months, the retail price of energy probably has increased by threefold. And that is predominantly due to the input costs, and that is as a result of gas predominantly, but it is the price that we will pay to every single generator and every single market participant when you are buying power. So it feeds directly into retail tariffs, and that is the reason that we have seen our retail tariffs rise.
Thank you, Rupert. Question from Barbara there in terms of Octopus paying smart export guarantees. Why shouldn't we move to them? Octopus are a fantastically run business with a very innovative track record. I would say that, unlike them, and they have a very broad market offer, Good Energy's core and focus has always been on self-generators. And when our product is launched, we think it will be a market-leading one because of its ability to increasingly pay people closer to what they're actually generating. But as we get that launched, obviously, I'd expect consumers to make the comparison and make their decision. But we do intend to innovate so that we can have something that is competitive with the best offers out there. In those questions and a couple of questions I get in my own correspondence, I understand the impatience with getting this through. I would remind long-standing Good Energy customers that we have limits the amount of resource we can throw on any particular project. We very clearly have prioritised smart export, smart generation. It is the 60-70% of our in-house development capability is focused on that particular project, so it has the right level of priority for us. And by the end of the year, I look forward to showing the market and customers what it is that we are offering to see if we can continue to take share in that marketplace. And then lastly from Nick, and I think we're going to run out of time at that point as well, REGOs being used to support greenwash renewable offerings, will they eventually run out? So that may be a question we will have to come back to you on. I don't see necessarily any sense that it's the REGOs themselves that will expire. I think what we need to see is further changes in consumer regulation around what can and can't be called a branded green tariff. We saw some welcome movement during the summer in the fact that at least the worst culprits in terms of certificate-backed tariffs were dropped from the admissible universe, but the rest we'll have to wait and see. But if there's a more technical answer I can give, we'll happily revert after this presentation is done. I think that takes us through to time, Jake. So do you want to begin to wrap up?
Absolutely, Nigel, Rupert, thank you very much indeed for being so generous with your time there and addressing all of the questions that came in from investors this afternoon. And of course, if there are any further questions that are submitted today, we'll make these available to you immediately after the presentation has ended for you to review, and then add any additional responses where it's appropriate to do so. Nigel, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Well, I'd like to start by thanking shareholders and investors for taking the time to join the call this afternoon. Hopefully, we have successfully updated you into Good Energy's progress. And I would stress again, really, that what we can see in these results is that we're operating a resilient business in the face of an energy shock, which is every bit as significant as that of the 1970s in the oil market, and that we're managing to do so whilst investing selectively for the future. I think that future is important for this company, and frankly, it's important for us as a country overall, as we strive to become more independent in terms of our energy. It's smarter in the way that we generate and use it, and I'm hopeful that Good Energy can continue to play its part as an innovator within that environment. Thank you very much for your time and attention today.
Nigel, that's great. And Rupert as well, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Good Energy Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.